Hi, everybody. I'm Bob Marone for Westchester Talk Radio. And once again, we are with our friends at Hightower, Westchester. With us today is Richard Flahav. He's a private wealth advisor and director of research and planning at Hightower, Westchester. And we're fortunate to have him back with us today. Richard, how are you?
Doing well, Bob. Great to see you. Thanks for having me.
It's great to see you too. Now, we live in interesting times. Today, we're going to discuss a very timely topic of what investors should do in a bear market. Richard, can you give us a glimpse into how you stay calm during market drawdowns of this magnitude?
Sure. And thanks again, Bob. Always good to see you.
Always a pleasure, my friend.
So, obviously a difficult time for in the markets and what's going on there. I think just to start, I want to provide a little historical context. According to FactSet, since pretty much 1929, there have been more than 24 bear market periods. And a bear market is essentially, when prices fall 20% or so from their recent highs. And, as the economy goes through these cycles, and as you know, I mean, you've seen this, you'll likely see a recession or some market crashes a few times over the course of your kind of investment journey. So the best thing I think you can do is really plan for them. And when I say planning for them doesn't necessarily mean timing the market, right? I can't emphasize that enough. If you pay attention to all the headlines out there and all the experts who wrongly predict the next crash over and over again on a weekly basis. I mean, listen, the one thing we know is no one knows when the next one's coming, exactly what time and when and what month. And they just essentially adjust their predictions, over and over again. So the one thing we can do and the advantage we have is being that kind of longer term investor and being prepared before it comes. Building that all-weather portfolio, having diversified investments, uncorrelated investments, alternatives, cash, et cetera, et cetera. Funny enough, we're buying some treasuries recently. You can actually get some yield out there now as rates are going up. So haven't been able to have that conversation too often in the past decade or so, but times have kind of changed. But again, going back to that goal management, financial planning, you kind of want to win during both up and down markets, and you need a strategy in place kind of before the proverbial bear market kind of sets in. So again, start that investment process right away. Don't stop. Stick to it. Be consistent.
So what types of investments and strategies generally work during these kinds of downturns?
Yeah. And I think this is the, $1 million question, right? You get frequently in times like these, but I think, you look at every bear market slightly different, but, Peter always says this, but they often rhyme, right? And I think when you look at you look at back to the 70s, 80s, when you had these elevated inflation levels, again, what worked in those periods? It's a matter of going back and studying history and also looking to see what's transpiring now. When you're looking at companies, you're looking for cash flows, right? Strong balance sheets, companies that have pricing power through these kind of cyclical periods, they're likely to outperform. And you've obviously seen that recently with some of the growthier, high PE, technology type names that are a little more speculative, that were really zombie companies floating along based on these low interest rates and cheap financing that they could get. We invest predominantly in kind of actively managed mutual funds. We're looking for quality investment teams with steady asset bases. They've been through market cycles. Their teams have been in place a long time. And particularly, this is important, they don't change their stripes based on what the market's doing, right? If you're investing in a value fund or a growth fund or a small cap fund, if all of a sudden that small cap fund, which has never owned energy, started buying large cap energy stocks, okay, the red flag should go up. Going back to that individual stock piece, following kind of Buffett's strategy, right? Look for businesses that are on sale that are, and this is what our mutual funds are doing, right? These portfolio managers, looking for those healthy balance sheets and also competitive advantages, right? Market share, et cetera. But I think with so many people concerned about really what's happening in the market, you got to go back to what works and what's worked over time. The other piece here, I think, too, in this environment has been, like I said, you're getting some yield now on CDs and treasuries, a 6-month CD and treasury. And, I hate to put a time on it, but you can almost get about 3%, which is pretty strong on an annualized basis. And then also alternatives. I mean, you look at some of the uncorrelated pieces, right? Whether it's managed futures, private equity, some hedge fund type vehicles, real assets, real estate, et cetera. Those tend to do well in these types of environments when you get these excesses, whether it's money supply, et cetera. So, but I think the most important thing, regardless of the type of investment, when you're buying it, think about it over the long term, right? Think about it over a 3 to 5 to 10-year market cycle. Don't get too fixated on the price now or where it is in a month or a year from now. Aim at that long-term growth. And I'll quote, not quote, but reference Charlie Munger, who's Warren Buffett's partner there. He was on Yahoo Finance maybe last year, earlier this year, and they asked, hey, if you were the czar of markets, what would be the one rule you would implement? And he said, well, the one rule I would implement would be you can't sell anything you buy within a year. And I think that's a good way of looking at your portfolio and how you invest and how we invest. Because as you know, Bob, time in the market, it's not timing the market. So.
Wow. I think you've underscored it, but investing is very emotional, Richard. Talk to us about the psychology of investing during downtimes, during periods like the one we're going through.
Yeah, and it's funny. I was out at a networking event recently, and I made the joke that I'm actually a psychiatrist. I'm not actually it's a part of the job. But listen, there's no way of sugarcoating it. Bear markets feel awful. They feel awful for us. They feel awful for our clients. All the above. We feel that pain just as much as anyone else because we invest alongside of our clients. We own a lot of the same things they own. And this is really the first challenge in the markets I think we've seen in almost 15 years, right? You get newer, younger investors who have never seen this red ink on their statement. What is this, right? And I think the important thing is just talking to people, tune out the noise, take the emotion out of it, right? Focus back to that financial plan. What are the goals of the assets? What are you looking to do with your investments? What is your risk tolerance? Just because the market's changed doesn't necessarily mean your risk tolerance should change. The big thing I always tell you is, listen, with the 24/7 news cycle, with the phones, the ability to look at your account on a regular basis, it doesn't help the cause. Try to, put your head in the sand, put your phone in the sand for a little bit and understand that, we have a plan in place, and I always speak about the financial plan. We use very conservative estimates when it comes to rate of return on these financial plans. And if you look at your performance over the last 5 to 10 years, probably pretty strong based on the market. So look at that annualized rate of return and know that we've cut out, a percent or two underneath that. So you're gonna feel safe, and the portfolio is going to be intact as well as the goals.
I know you mentioned the Sage of Omaha earlier, but what about now? Is it time to start buying during this dip?
Yeah. And that's a big one too, right? That's one we get a lot. And I think it's the right question to be asking. I think if you're a client, come to us with cash and new money, dollar cost averaging in makes the most sense. And really that's just the practice of, investing a fixed dollar amount on a fixed regular basis, right? Regardless of share price. You're going to get that average cost of that mutual fund, ETF, stock over whatever time period you pick. It's a good way of kind of developing a discipline around investing. It's an efficient way of doing it. And I think the most important thing is just don't blindly follow experts into buying, right? Because as you know, you can make stats look any way they want, and you can flip one channel that's saying, hey, buy, and you go to the next channel and it's all doom and gloom. So, have a plan going in, and whether you're buying individual stocks, ETFs, the mutual funds, I will say, I will kind of preface that, and I'd put an asterisk there. If you're buying individual stocks as an individual and you don't have the time to track them, that can be very difficult, right? Knowing when earnings are coming out, reading through transcripts, et cetera. So I would caution people and investors to, it's a big undertaking. And if you're not going to really have your ear to the ground, it might be something better off for an advisor or someone else to take part in. But this is a stock picker's market. Buying ETFs over the last decade has been important because you've gotten pretty much 100% of the upside, which over the last 10 years has been a good thing. But buying an ETF, which owns the whole market, or the whole indice is you're going to get 100% of the downside.
Mm-hmm.
So now is the point where buying an actively managed mutual fund, being a little bit more proactive and looking to see what funds make the most sense, what stocks make the most sense. But to kind of dance around, don't mean to dance around your question, but I think the most important thing is go back to the plan. There's still plenty of headwinds out there right now, given the market environment. But this is where having potentially someone like ourselves can really help, mitigate that. You get a little anxiety around, hey, am I missing time to buy? Am I too late? I think the important thing is to stick to the plan and really start to implement that according to the market and what it's giving you.
Any other advice, Richard?
Yeah, I think I've kind of danced around it a little bit, but market timing doesn't work. For every, investment undertaking, you need to be right. You need to be right twice, right? When to go in, when to get out, or vice versa. That's a difficult thing to do. Like I said, I think this is a good time to say, hey, listen, I have a plan in place. I'm going to take, some time and resist the urge to run or do anything stupid, right? Know what you own, right? Understand why you own it, what your exposures are. And that's something that, we can help you with. You're not alone on this journey either, right? Whether it's you have an advisor, whether it's a friend or family member, talk to them, understand what you have. One thing I heard recently was think big and act small, right? You don't want to make drastic changes to anything. You got to understand what the big picture is. If you want to make tweaks on the margin, think it makes sense, but keep everything in perspective, right? Bear markets lasts, according to FactSet, 24, 36 months, give or take. Bull markets are a lot longer than that by a multiple. So understand that, we're going to be in this and we'll get out of this. You're also going to see doom and gloom headlines everywhere you turn right now, right? It's, as we know, that sells. So again, take that for what it is. And I think avoid acting out on that emotion and illogical reasoning. So, but you mentioned the Oracle of Omaha there, Warren Buffett. Hey, listen, he's buying right now. And I think that tells you something. So
it really does. I had one more question before we go on our way. You mentioned headlines. You mentioned, and I wrote some notes about cell phones and tweets. We live in an environment where people get instant gratification, TikTok, Reddit, move, act, respond. Now, when the market's like it is, how do you keep your clients from reacting to all of the stimulus?
Yeah, no, it's a very good question. And this is, I think, prompted more phone calls than I think most would like. And I think it's caused a lot more nervousness across the gamut there. It's funny. I was talking to someone recently. I said, listen, if you find your news within a couple seconds, it's probably not either that accurate or that, in depth of a thought. So for us, it's okay. Yeah, that's the headline, but what does that mean? Let's dig a little deeper. And I think when we talk to clients, it's okay. Yes, they're saying this and maybe partially true, but does that change your risk perspective? Does that change your financial plan? Again, it's all going back to that goal management. But listen, it is difficult. Fear sells, as we know in the news. And I think the important thing is to, take a step back, kind of put that out of your head and understand, listen, we have a plan in place and we're sticking to it. If that changes or something changes in your life, that's different. That's a conversation we can have. But again, try to stay away from the flash, the big, banner going across the headline. I mean, listen, we're all guilty of it. We have, the news on all the TVs here in the markets and we see the headlines flashing. I always laugh when, tomorrow they're looking at, the Fed will speak on whether they're going to raise rates and by how much. And, one of the news outlets has the time, countdown. 20 minutes till the Fed decision. Yeah, oh my God, really? So that doesn't help. But, like I said, focus on the long term, focus on building an all-weather portfolio that's built around your goals and you'll be fine.
Richard Flahav, Private Wealth Advisor, Director of Research and Planning at Hightower. Once again, thank you very, very much.
Appreciate it, Bob. Thank you.
Hightower Westchester is a group of investment professionals registered with Hightower Securities LLC, member FINRA and SIPC, and with Hightower Advisors LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities LLC. Advisory services are offered through Hightower Advisors LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as a general market commentary. It does not constitute investment advice. Hightower Westchester and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This podcast was created for informational purposes only. The opinions expressed are solely those of Hightower Westchester and do not represent those of Hightower Advisors LLC or any of its affiliates. Hightower Advisors do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax advice or tax information. Tax laws vary based on the client's individual circumstances and can change at any time without notice. Clients are urged to consult their tax or legal advisor before establishing a retirement plan.